Okay, let's go now. Case 2, business case with the financial revamp for Gourmet Heaven. Now, the background is Gourmet Heaven is a mid-style restaurant located in downtown Vancouver. Has been stable in the community for the past 5 years. So they passed the COVID, everything's fine. Now they start having problems. Specializing in highly quality, locally sourced cuisine, the restaurant has built a strong customer base and reputation for the excellence. However, the business is currently facing financial difficulties. Appendix 1. So if we go to Appendix 1, which is given like these numbers, what I said the other group, what I want you to do is get the information, copy it like this. Once you copy the information like this, what I want you to do is open one Excel spreadsheet format. Let me see where's the Excel spreadsheet format that file that I just opened. Just give you a second to see where it is. Okay, here's the new one. Okay, open one Excel spreadsheet, and what I want you to do, copy and paste everything here. So once you copy and paste it, you're gonna have everything on one page. So once you do it in one page, then format it, do some formatting here. And get your numbers. So basically, once you do a little bit more adjustments on the years and the totals, you're gonna get the right information. And once you do those things, so what you have to do is calculate the total assets. So put on one line here, calculate the total assets, get the that will be current assets, that can the this one will be the separation between the current assets. Put one line here, get the total assets, and label it like this. Then go with the liabilities, get the long-term loan total liabilities. You can spread it with the short-term that this case is just total liabilities. Separate the total that's your liabilities here. They end up here, and then you have the total equity is right here, and then you're gonna have the total equity and liability and right here, and you can keep going, keep going, keep going until you get your reports, which reports should look like this. So once you do that, everything's gonna look like this. So why do we need those things? Because later on we're gonna start working, and we're gonna use those reports. Once you get those reports, we're gonna use those reports for the forecast. I'll show you how. So what we can see of those reports, we can see that first, the cash slowly going down, accounts receivable is going down, inventory is going down, uh, total current assets going down. Total, now you can split those one and get the current assets here easily. So you can do that calculation by yourself, get the current assets and see what the current ratio is. Obviously, current ratio is not going to be in a good position. You're going to have 24,000 current assets and $72,000 current liabilities, which the current ratio is way, way, way lower. So you can get the current ratio by current assets divided by sum of current liability. That will be sum of current liability, which is that much. And you're gonna give you the number. Once you click yes, that will be current liability, and how the current ratio goes through the years, you can easily see it: 24, 23, 24, 22. Those are the years, that's the current ratio, and you can see what's going on with the current ratio. How from 1 going below to 0.5. Now it's 0.34. And the other thing that you can see is from 5,000 22. Now we are minus 75. That's what you can get from here. So let's stop sharing this. You can do this by yourself. There should be no problem with that. Once you have this one-on-one on the statements the way I show you, then you can keep going. The restaurant owner, Maria Lopez, has approached your team for the comprehensive financial analysis and specific strategic plan for revamp the business positions. Government Heaven has recently experienced decline in profitability due to the rising cost and the increased competition. Despite the effort to attract more customers, the restaurant is struggling with the maintaining margins. The business is considered several strategic decisions for address those changes. So we have several strategic decisions. This one is the one decision. Second one is this one. Let's cover this part. Now the next one is this one. Different options here for the business. Now we have to decide which one will be the most appropriate. Revised monthly budget, prioritizing that might be the another one. We have to see and we have to think about it, which one is what. So let's start with the first one. Increase menu prices by 10 will impact the customer demand and revenue. Okay, so now we're chasing the increase menu price with 10%. So the average customer spends 25 per visit with 150 daily customers. This is from where you're gonna get your revenue. Average customer spending 25 per visit, 150 daily customers. Now, once you have this, you get the daily revenue. The question is, how many days per year we gonna work? Now, we have 365 days, correct? 365 days per year. Can you work all the 365 days? Preferably, yes, but in reality, no. We need a 1 day per week, or at least 1 day per week, to be closed. So that's 52 weeks, that's 50 days, 52 days. Plus, we're not gonna work on the stat holidays. Let's pretend we're not working the stat holidays and we have 12 stat holidays per year in Canada. That means we're chasing 64 days. For simplicity, let's make it 65 and let's leave it 300 days per year. You have 300 working days per year. So once you know that, you can clearly calculate how much will be your revenue, annual revenue, if you have 150 customers daily, they spend $25 per visit, and you're working 300 days. You can get the numbers right away. Now, historical data suggests that a 5% decline in customer volume per 10% price increase. So if I increase this price with 10%, if I increase the price with 10%, go to the 27.50, potential reducing daily customers will be, now the customers from 150 is going to drop down to 145, 42 and a half. How the half customer is going to come, I have no idea, but let's assume it's a half. So what you have to do is show me the impact. What's going to happen? What's my revenue in this situation? And what's my revenue if I have 142 and a half customers, 300 days, and they spending 27.50 in average? Tell me how much will be my revenue. While fewer customers may be dining, the increasing pricing is projected to boost the overall revenue, requiring for you to analyze the net impact on the profit margin and the bottom line. Bottom line will be the net income. From where we're going to get the net income? Now, in this situation with the purple line, Let's go back to the Excel spreadsheet. That's why we need that. That's why the Excel spreadsheet will be crucial for you to start with. So once you have this calculation, once we have this, what you can do is by having this, you can clearly insert one column here, which will be your projection. First projection is 10% increase in, actually, no. You know what? No. What I want you to do is get this number because we're chasing the income statement, correct? We're chasing the revenue expenses. Get this information. First thing I want you to do is, based on our new calculation, right, the one that we just did for the revenue, calculate me, please, how much will be my revenue based on our assumption. That's what I want you to do first. Calculate the revenue that we're generating when we have, a second, when we have 150 clients time $25 spending time 300 days. So that will be your starting projection, 2025. So what's going to change? This number is going to change. This number is going to stay the same because we don't know anything about the cost. We're assuming the cost is going to stay the same because this is currently, that's what we're currently doing. This number definitely is going to change. So cost, that's not changing. You're not changing this number. You're not changing any of those. Everything stays the same. That will stay the same. Now this one's going to change. Why? Because I'm changing the sales revenue. Interest expense is going to stay the same. We're not changing those one. And the net income is going to change. And this is 2025 with 10% increase in the sales price. That's what I want you to do. So here for this scenario, you're going to have 142.5 people spending $27.5 for 300 days. Actually, this is the starting point. Actually, here, this 10%, I want you to put it right here as a second column. This will be the second column. This one will be 150 here for 25 for 300, no 10%. So then run the numbers here and start comparing this column with that column. Make sense? Group 2, do you understand what you have to do? I hope you do. So that's what you have to do. Once you get those one, stop sharing here. And let's go back to the case. You can do the calculation, comment on the number, see what's changing. Obviously, profit's gonna change, income's gonna change. How much is the change? Make a conclusion. Should I implement the 10% in a 10% increase in the sales price or not? That's your bottom line here. So first one is to calculate the original information with $25 times 150 customers times 300 days. Calculate the net profit at this point. This is your bench. This is your the base point. And then start comparing up to that base point. What's going to happen if I increase the sales price to 27.5 or 10%, which will reduce my clients with 5% to 142.5. And that's going to be on the 300 days again. And comment on the results. Discuss the results. Provide me a recommendation. Finish with conclusion and recommendation on which one is beneficial. Is it beneficial for me? Are you advising me to increase the price with 10%? That's first thing. Second, we're going to the next scenario. Introducing the budget-friendly menu during slack time, happy hours. Slack time, we don't know what the slack time is. We don't know how many customers going to be affected. We don't know anything about this. that could attract a wider customer base while preserving the restaurant brand equity as a quite high quality cuisine. The proposed menu would feature meals priced at $12 compared to the current average spending of 25. So basically now our people not spending anymore 25, they're spending $12. This initiative aimed to increase the foot traffic with 20%. So I'm expecting the 20% increase in the number of people, compensating for the lower price per meal. Additional cost of goods sold would increase by estimated 15% to enhance the margins budget item. You must evaluate whether the higher sales volume would offset the lower per unit revenue and how this is going to affect the contribution margin per meal on overall profitability. Now, since we don't know the variable cost per meal, since we don't know how many meals are done, we're just having some numbers. You cannot do anything with that contribution margin. So I don't expect you to do anything on the contribution margin unless you are some kind of wizards, which you can look at the crystal ball and find out something that's not here. So I not expect you to do contribution margin. However, I expect you to get this information here and incorporate it in the Excel spreadsheet. So let's go to the Excel spreadsheet. What I expect to do now, you to do now. What is expected from you is once you have this situation here, this scenario here, now we have to again use it as a benchmark. So that means whatever we did for the 10% increase, that's not longer applicable. We're doing new calculation. In our new calculation, first, we're reducing the price for $12. We're increasing the number of people. Let me see how much was the increase. We're increasing the number of people with 20%. Make sense? We're going to have here plus 20% increase. So whatever it is, 150 plus 20%, and you get the number. Now, the days still going to be 300 days. So you can calculate the revenue here. Cost of goods sold. On the cost of goods sold, you're increasing the cost of goods sold with 15%. Whatever it is right now, you're adding plus 15% increase. And you're going to see how much is it. What will be the new number? Those are the only increases that you're doing. You're not touching anything on the rent, on all the fixed expenses. Pretend that those are fixed expenses. You will not touching those ones. So this number is going to stay the same. So whatever it is here is going to stay the same. Then see where the not operating profit is. Interest expense stays the same. So those ones stays the same. All those stay the same. This calculation stays the same. So what's going to change? This number is going to change. Definitely this number is going to change. This number is going to change. And the bottom number is going to change. Compare those two columns and see what's happening. Comment on the results. Make sense? That's what you have to do in this situation with this blue scenario. Now you can comment on the profitability and you can comment on the gross margin. Don't comment on the contribution margin because we don't know which one is the variable cost. You may have some fixed costs in the cost of goods sold. We don't know if all the cost of goods sold are variable costs. We may have some fixed costs. So for that reason, no comments on the contribution margin. I don't want to see anything on the contribution margin. I want you to be technically correct. For that reason, comment only on the gross margin here and on the profitability. And then once you do that, recommend. Should I go with the happy hours scenario for the whole day and change from the 27 from $25 to $12 with the new calculations? That's what I want you to do. That's number two. On the number two, again, you have calculation part, you have the uh, discussion part with conclusion and recommendation. Don't ignore those one. Now we're moving to the red scenario. Cost-cutting measures such as renegotiating supplier contract and optimizing labor cost offer another alternative for financial improvement. Government haven't could have significantly could save significantly on the ingredient expenses by securing a 10% reduction in the raw material cost. Additionally, reduction of the overtime expenditure with 5,000 per month could enhance profitability without affecting service quality. So we're not touching the quality, we're just reducing the cost. Those savings will contribute directly to the restaurant bottom line, requiring you to analyze how those cutting strategy affect the overall business efficiency. Also provide recommendation on how sustainable those strategies are. So what you have to do now, go back to the Excel spreadsheet and start working. Now this one, it's gone. It's not longer on the table. We have a new scenario here. What will be the new scenario? We're staying with the 150, our original data, the one that you calculate as original, the starting point. Then after that, what you're doing is, first, you're reducing the cost of goods sold by 10%. After that, you're reducing the wages and salary with 5,000 per month. That would be minus 5,000 per month. So come up with the annual, see what will be the effect for the entire year. Run the numbers, see where you are. In this case, this number is going to change. This one not going to change. This is going to change. There is no changes in those numbers. This is going to stay the same. All those numbers going to stay the same. This number is going to stay the same. This one's going to change. This one's going to stay the same. There will be no change in that number. That's going to stay the same. But profit's going to change. Net income is going to change. So that will be your new comparison that you have to make. And that was in that kind of color. So run the calculation, compare this scenario with this scenario, see where you are. Most likely, you're going to end up with the high net income, most likely. Because again, we're touching only the costs, we're reducing the costs. So that's going to change the net income, is going to change, affect you positively here. The last thing that you have, once you do the calculation, that's number 3, once you do the calculation, once you comment on the numbers, make a discussion on the numbers, conclusion on the numbers, then you have to provide a recommendation on should I do those reduction and cut the overtime, or should I stay on the original situation? That's the first recommendation. Second, you have second portion of the recommendation here. Second portion of recommendation will be your recommendation of sustainable, how sustainable are those strategies? How those two strategies going to affect the sustainability of the business? So it's not going to be exactly a recommendation, but it's going to be more like a discussion here. I want to see discussion in form of recommendation, but I would clearly said that I'm looking for your discussion on how sustainable is 10% reduction of the raw material cost and 5,000 reduction per month on the labor. What you can have in mind here that the possible increase on the raw material cost and it's not possible, the increase in the minimum wage of the labor in BC. Let's make it a little bit more practical. Discuss those two. If you want to go that direction. If you don't want to go that direction, any discussion on sustainability will be valuable here. Then we're moving to the green part. Now, the green part, now a revised monthly budget that prioritizes essential expenses while reducing the discretionary spending is crucial for financial recovery. Fixed cost, including rent, wages, utilities, approximately 20,000 a month. Fixed costs, including rent, wages, utility cost, approximately 20,000 a month. By setting 50% reduction target on the discretionary expenses, such as marketing and advertising, the restaurant can reallocate funds to critical areas. You need to consider how those cost-cutting strategies affect the overall cost allocation and develop budget that balance cost-cutting with the maintaining business operations. So this is another one. We're going to revise the budget by prioritizing the essential expenses and reducing discretionary spendings. Now, the fixed cost, which including in rent, wages, utility, cost approximately 20,000 per month. So which are our fixed costs? Let's go back to the chart that we have. Now we're going again for the new scenario. So whatever you did on the previous part, that's gone. Gone. New one. On the new one, there will be no changes here. That will be the revenue is going to stay the same. Whatever you're calculating on the original, gross profit is going to stay the same. What we're chasing now? We're chasing that rent, wages, utilities. So the rent, wages, and utility, you're not touching those. Those will stay the same. We cannot fix those one. Those will stay the same. But what's going to change? Marketing, maintenance, and other expenses. All those, it's going to reduce by 15%. So we're going to have here reduction minus 15%. Next one, minus 15%. Next one, minus 15%. What's going to change? This number is going to change. Operating profit is going to change. Interest expense not going to change. And the bottom line is going to change. So you're running your calculation. See where the numbers are. Comment on the numbers. That's what you have to do here. Compare what you get in this situation versus what you get when you cut the costs. Compare those two situations and comment on the results. And see, talk about the cost cutting. You need to consider how those cost cutting affect the overall cost allocations and develop budget that balance cost cutting. So once you develop that budget, you're gonna talk about the effect on that will be number 1, 2, 3, 4, 5, the 4 here. Again, you need calculation plus discussion, conclusion, and recommendation. Is it profitable for me to cut those costs or not? Obviously, it will be profitable since I'm reducing only the cost and not touching the revenue. Now, comparing the profitability of adding delivery service. So now we have a new scenario here. And the new scenario, I don't know what kind of cover is gonna make it now. Let's make it that kind of cover, another blue cover. Now, comparing profitability of adding delivery service by partners, a partner with Uber Eats, Skip the Dishes, another newly growing food services provider, versus investing in outdoor seating involves specializing and for potential revenue increase. So we have two options here. Option one, adding delivery service. Option two is outdoor seating. To set up the deliveries, to go with the option one, we have to spend $10,000 investment, but we can increase the revenue by 10%. That's for option one. Well, if we're expanding for outdoor seating, we have to spend 15,000 with potential boost on the revenue 15%. What you have to do, you have to evaluate those capital budgeting decisions and determine which investment yield is higher and align with the customer demand trends. So now we don't know the customer demand trends. Don't go internet. I don't want to see anything resources of the internet posted in your report. I want you to think from your perspective. From your perspective, you're the young generation, you're the consumers. From your perspective, which one will attract more customers? Make them lazy, staying at home, purchasing from Uber, skip the dishes and anything like that. I mean, don't get me wrong, they still have to clean the dishes and use the dishwasher when they're eating, because the skip the dishes not gonna go home and wash your dishes. That's one thing. Or sitting outside. Which one you would prefer? And comment on from your personal perspective. I don't want to see any internet what the internet think about it, what the other people. I want to see what you think about it. So how you can do this? I mean, obviously you have to do the calculation. Calculation will be very simple, should be very simple. For that calculation, again, you need this thing. Now, what's happened in the previous one, it's not longer available. Now we're going to the two things. This is the current situation, which you have to calculate, right? And then you have two options. Option one and option two. You have those two options. On option one, what was the option found? Oh, the skip the dishes. And the skip the dishes. We, on the all the costs that we have, all the costs what we have, we're gonna add new cost, 10,000. We're gonna add this cost. We're gonna keep everything else, but we're adding new cost. Plus, what's gonna happen plus? We're gonna increase the revenue with 10%. And you're gonna run the report, the numbers, see where you are. Now, comparing option one, the objective here is to compare option one based on the, not that one, that should be automatic, the color should be here. Option one and option two. That's what you comparing. Nothing more, nothing less. So for the option two, you have additional operating expenses of 15,000, not 10,000, 15. But that's going to increase your cost. Everything else stays the same. All the other things going to stay the same. But your revenue now is going to increase with 15%, not 10%, 15%. Run the numbers, see which one is more profitable. Whatever give you higher income here, I recommend that option. Make sense? Okay, uh, let's close this one and let's go back to the case. So again, that's number 5. You have a calculation here. You have a discussion on the both options. Then you have conclusion on the revenue side and recommendation, which option this company should I choose. Now, let's go with the next one. Outsourcing dessert production could reduce the in-house preparation cost and improve the efficiency. Dessert cost 350 per unit were made in-house. Outsourcing reduced cost to 275 per unit. However, outsourcing may impact the quality and brand reception. Identify any financial or non-financial factor influencing the decision to in-house preparation or outsource. You might weigh the cost of the saving against the potential risk. Customer satisfaction concern to determine the best action. So here, out of this paragraph, what you have to do is you have to decide. Not that one. Let's change it to different color. Then like this. So what you have to decide? You have to decide on make it internal, make versus buy. You don't have numbers to compare the numbers, but you can do the qualitative analysis. You're gonna do the qualitative analysis and you're gonna give me 3 reasons why should I make it at house, 3 reasons, 3 pros of make it in-house, and 3 cons of not making in-house. Then you're gonna give me 3 pros, discuss, not only identify, but discussing those 3 pros of outsourcing it and 3 cons of outsourcing it. Based on this analysis, you're gonna provide conclusion and recommend what would be better for me to make it or outsource it or buy it. Both are legit options as long as you can provide logical analysis, comment on that analysis, and provide logical conclusion and recommendation. There's no right and wrong, so you don't have to worry about that. Everything can work here. That was issue number 6 for you with all the things. So inside they have more issues. Now, according to the government of Canada, food loss and waste of the food supply chain, British Columbia critical. The food service industry, preliminary restaurant and catering, contributes to 1.44 million tons of waste and 4.14 billion, 13% in BC. Government have experienced a high food waste due to the inventory management inefficiency, with approximately 8% of the total purchase amount to $20,000 per year being discarded. The restaurant aims to cut the waste by 50%. So if they cut the waste by 50%, what that means? What would be the number that they're planning to use? By implementing the striker tracking and purchasing control. Eliminating the food waste significantly reduces the restaurant carbon footprints and contributes to achieving the United Nations Sustainable Development Goal. Responsible consumption and production. I don't know if you follow the United Nations, but they already agree that this doesn't work. You must identify area where the inefficiency occur to promote measures to optimize inventory turnover, minimize the spoilage, and achieve sustainability. You must identify where. So, what you have to do is what I want from you here, and that will be number 7. Comment on the numbers. You can say currently you're spending 20,000. You can cut it by 20,000, by 50%. You can cut it by 50%. You can reduce it to 10,000 per year. Now that's the one thing that you can do. But the next thing I want you to do is I want you to give me 3 ideas how to reduce my wastage. You know the reason why I'm wasting. Because I have inventory management inefficiency. This is the reason why I'm wasting my money. I have inventory wasted inefficiency. Find me the way, three ways, three ideas how to improve my inventory, how to optimize my turnover, means how to sell more of my products, and how to minimize the spoilage, how to achieve sustainability, means sustainability to keep the same model for the longer period, not only 1 year to achieve that thing and then go back to the 20,000, but long term, long term. Make sense? Three ideas on the inventory turnover, minimize the spoilage, and how it is going to affect them. And discuss those ideas. Once you get the ideas, then give me the conclusion and recommend me of the course of action. That will be number 7. And the next one is the strengthening the cash handling process is vital to reduce the revenue leakage and improving the accountability. Monthly revenue discrepancy amount of 2,000 likely due to the errors in cash reconciliation, lack of the oversight, implementing the tighter point of sales control, staff training, and regular audit will help to mitigate the losses. You should develop strategy to improve the audit and overseas measure to cash flow and security operating transparency. So what I want you to do is this one, consider it as this one is your internal control problem. Internal control, that's number 8. Internal control. Discuss which internal control you're having problem with. What's the impact? Provide me discussion, comment, and recommend improvement, which are actually is going to help me to cut that discrepancy of 2000. Next thing I want you to do is do some here for the sustainability and for the environmental impact. I want you to identify 9, find some ethical problem. You have to be able to see something ethical here. See what you can find. I want you to discuss at least one ethical issue in this case. Find something ethical, discuss it. Now, deliverable, you must provide a detailed financial analysis, recommendation, presentation format, along with executive summary highlighting the key strategic action barrier to implement a long-term sustainable decision. Conclusion, government haven't presented the challenging yet realistic scenario to apply the accounting knowledge area of business program in conducting this industry. And that's your case. So as the other group, in the beginning, I want you to start with the introduction of the company. Talk a little bit about the company. You have the financial statements, explain the current financial situation, comment on the current ratio, comment on the debt to equity ratio. Since you don't have to discuss it through the report, comment in the very beginning. Tell me that the company is on the curve of losing money. Year after year, they're losing money, current ratio going down. So company has to improve the situation, and then you're coming and start assessing the situation. So basically, in the very beginning, give me the overview of the company. At the end, at the very end, once you finish with all the things that you have to do, don't forget the ethical issue. I'm gonna chase you for the ethical issue since I'm telling you that you have to find the ethical problem here. You can extract it from the sustainable development goals or sustainability or the environmental waste and everything. You can extract something ethical here. Once you discuss all those things at the very end, like the group 1, I want you to repeat all the recommendation on one place so the users of the report to see the recommendation at the end, all the recommendation, which one is better for me. So which one is better for the company? Should I stay with the normal or the Happy Meal, or should I go on the what was that, Uber and this skip dishes, or should I put more chairs outside? Should I cut on the discretionary cost, or should I not? What exactly should I do? All the things, all the recommendation, I want to be listed at the end so you can show me the improvement in the situation. And that will be your case.